The pure-play nature of Antero Midstream's asset base in the Appalachian Basin, specifically the Marcellus Shale of West Virginia and formerly the Utica Shale of Ohio, provides a geographic concentration that allows for significant operational scale and synergy. Unlike diversified midstream entities with sprawling networks across multiple basins, the corporation's assets are contiguous and highly utilized, benefiting from the low-cost structure of the Marcellus region, which remains North America's premier natural gas reservoir.
Antero Midstream has an integrated relationship with Antero Resources. As of late 2024, Antero Resources held a 29% ownership stake in the corporation, creating a structural alignment that dictates capital spending, infrastructure development, and cash flow priority. This relationship is not merely financial but operational. Antero Midstream functions effectively as the logistics arm of Antero Resources' upstream development, providing gathering, compression, and water handling. Historical trajectory and the shift to free cash flow. The period between 2020 and 2025 marked a pivotal inflection point in Antero Midstream's financial history. In 2020, the corporation was emerging from a phase of high capital investment, reporting a free cash flow before dividends of approximately $498 million. During this time, the corporation initiated a strategic shift toward a maintenance-level capital program, prioritizing debt reduction and dividend sustainability.
By 2021 and 2022, the impact of the drilling partnership between Antero Resources and its investment partners began to manifest in increased throughput volumes. In 2022, the corporation's adjusted EBITDA reached $748 million, a figure that grew to $825 million by 2023. This growth was not merely the result of increased drilling, but also of the fixed-fee nature of the corporation's contract, which provides stable revenue regardless of commodity price volatility. The following milestones define the corporation's recent historical financial profile. 2023, adjusted EBITDA reached $825 million, and net income was $354 million, with capital expenditures between $195 and $215 million, and an estimated Q4 run rate of $155 million for free cash flow after dividends. 2024 achieved an adjusted EBITDA of $1.05 billion and net income of $401 million, with capital expenditures of $161 million and free cash flow after dividends of $250 million. 2025 estimated. Projections indicate an adjusted EBITDA between $927.8 million and $1.114 billion, net income of $472.4 million, capital expenditures from $170 to $190 million, and revised guidance for free cash flow after dividends of $300 million.
The transition in 2024 was particularly significant, as Antero achieved an adjusted EBITDA of $1.05 billion and generated a record $250 million in free cash flow after dividends. This performance allowed for a leverage reduction to below 3.0x net debt to adjusted EBITDA, meeting a long-standing management target. 2025 performance and forward guidance. In the first 3 quarters of 2025, Antero Midstream maintained this momentum. Net cash provided by operating activities in the first quarter of 2025 was $199 million, compared to $211 million in the first quarter of 2024. While this appeared to be a slight decrease, it was primarily attributed to the timing of semi-annual interest payments on senior notes and an increase in direct operating expenses, rather than a fundamental decline in asset productivity. By the third quarter of 2025, the corporation reported robust year-over-year improvements across key financial metrics. Adjusted EBITDA, $281 million, representing a 10% increase. Capital expenditures, $51 million, representing a 9% decrease. Free cash flow, post-dividend, $78 million, representing a 94% increase. Net income per diluted share, $0.24, representing a 14% increase. This performance was driven by a 5% increase in low-pressure gathering volumes and a significant 30% increase in freshwater delivery volumes.
The third quarter of 2025 represented the 11th consecutive quarter of generating free cash flow after dividends, a streak that has allowed management to pursue a balanced capital allocation strategy of debt reduction and share repurchases. The revised 2025 guidance points toward a full-year free cash flow after dividends of $300 million, an increase from the initial guidance of $275 million. This upward revision is the result of multiple factors: higher than anticipated EBITDA, lower maintenance capital expenditures, reduced interest expenses as debt is retired, and a lack of material cash taxes expected until 2028. Mechanics of cash flow, the segment view. The corporation's cash flow is derived from two primary reporting segments: gathering and processing and water handling. The gathering and processing segment manages the physical movement of natural gas through high-pressure and low-pressure pipelines and compressor stations. In the first quarter of 2025, gathering and compression revenue from Antero Resources totaled $238 million, representing the majority of the corporation's top-line revenue.
The water handling segment provides a closed-loop solution for freshwater delivery and wastewater handling. This segment is particularly profitable because it leverages an integrated water system that allows for high-rate pumping and recycling, reducing the overall lease operating expense for Antero Resources while providing a high-margin service for Antero Midstream. In 2024, water handling revenue was bolstered by record completion efficiency, with Antero Resources achieving up to 14.5 completion stages per day, which directly translates to increased water throughput for Antero Midstream. The sustainability of these cash flow segments is protected by long-term fixed-fee contracts that include annual Consumer Price Index (CPI)-based inflation adjustments. This indexing mechanism is a critical feature of the midstream model, as it ensures that operating cash flows are hedged against inflationary pressures on direct operating and general and administrative expenses. The HG acquisition and Utica divestiture. On December 8, 2025, Antero Midstream entered into a definitive agreement to acquire the midstream assets of HG Energy for $1.1 billion in cash, while simultaneously agreeing to divest its non-core Ohio Utica Shale midstream assets for $400 million.
The strategy involved divesting assets with limited future development potential and low capital efficiency in favor of contiguous infrastructure in the heart of the Marcellus Shale. The divested Utica assets had a limited development horizon, with only 3 wells expected to be turned in line over the next several years, generating an estimated annual EBITDA of $35 million. By selling these assets at a multiple exceeding 11 times EBITDA, Antero Midstream captured a valuation premium for a declining asset base. Conversely, the HG Midstream acquisition adds infrastructure in a region where Antero Resources is actively expanding its core acreage. The transaction components were structured as follows: HG Midstream acquisition, a strategic bolt-on acquisition of Marcellus gathering and water infrastructure from HG Energy 2 for a $1.1 billion cash outlay. Utica divestiture, a sale of non-core Utica gathering and water assets to Infinity/Northern Oil for a $400 million cash inflow. Net strategic outlay, a total net cash outlay of $700 million to reposition the asset base toward the core Marcellus fairway. This acquisition is contiguous with the corporation's existing Marcellus footprint, allowing for immediate integration and the realization of significant operational synergies.
The financial logic of the HG acquisition is underpinned by projected synergies totaling approximately $100 million and discounted future capital avoidance. Because the HG assets are directly adjacent to Antero Midstream's existing network, the combined entity can optimize development planning and eliminate the need for redundant pipeline builds or compressor station expansions. The acquisition price of 7.5x the estimated average annual EBITDA over the next 3 years is considered attractive, especially when compared to the 11x multiple achieved for the Utica divestiture. Furthermore, the HG acquisition is expected to be immediately accretive to free cash flow after dividends by more than 15%. The deal adds roughly 900 mmcf/d of throughput capacity starting in 2026 and provides over 400 undeveloped Marcellus locations dedicated to the corporation, effectively extending its inventory life by approximately 5 years. The integrated nature of the deal, where Antero Resources simultaneously acquired HG's upstream assets for $2.8 billion, ensures that the midstream infrastructure will be utilized at a high rate.
This coordinated move by the parent and the subsidiary reinforces the stability of the long-term cash flow stream and mitigates the risk of underutilized capacity in the newly acquired assets.
Valuation analysis. Valuing a midstream corporation like Antero Midstream requires a multifaceted approach that considers its high dividend yield, its stable fee-based cash flows, and its growth prospects relative to its peer group. The valuation models for Antero stock generally indicate undervaluation relative to intrinsic fair value. Relative valuation, peer group, and multiples. Antero Midstream trades at a diverse set of multiples when compared to its broader midstream peers. Its enterprise value to EBITDA ratio has hovered between 11.6 and 12.1x in late 2024 and early 2025, which represents a slight premium to the 5-year average of 10.1x. This premium is largely justified by the corporation's lower leverage and higher profit margins relative to the industry average. A comparison with industry peers highlights the following valuation landscape. Antero Midstream trades at 12.1x EV/EBITDA TTM and 17.5x PE ratio TTM with a 5.2% dividend yield. Hess Midstream trades at 6.6x EV/EBITDA and 11.9x PE ratio with a 9% dividend yield. Energy Transfer trades at 8.7x EV/EBITDA and 13.5x PE ratio with an 8.1% dividend yield. Oniok trades at 10.2x EV/EBITDA with a 5.7% dividend yield.
On a price-to-earnings basis, Antero Midstream trades at approximately 17.5x, which is lower than some high-growth peers like DT Midstream, but slightly higher than the more highly leveraged Master Limited Partnerships, MLPs. Intrinsic valuation, discounted cash flow, DCF models. DCF analysis is a more rigorous method for determining intrinsic value, as it accounts for the time value of money and the specific free cash flow expectations of the corporation. Several independent analyses have provided estimates of Antero's fair value using varying assumptions for growth and discount rates. A two-stage growth model estimate puts the fair value of Antero at $28.24 per share. This model uses a cost of equity discount rate of 8.0%, which is derived from a levered beta of 1.21 and a risk-free rate based on the 10-year government bond yield. The model assumes a period of higher growth in the first stage, followed by a terminal growth rate of 2.8%. Another model, adopting a more aggressive best-case scenario, estimates the DCF value at $39.99 per share. This model projects a significant expansion in net margins to over 50% in the terminal period, driven by the completion of major capital projects and the full realization of the synergies from recent acquisitions. Given the corporation's recent strategic pivot, the FCF inputs for these models have been revised upward. The HG Midstream acquisition is expected to add over $100 million in annual asset-level free cash flow, which, when discounted at 8% WACC, adds significant net asset value to the equity. Dividend yield and yield compression. The dividend yield of 5.2% remains a core component of the Antero's investment narrative. While this yield is lower than the 8 to 9% offered by some MLPs, it is considered more sustainable due to the corporation's corporate C-Corp structure and its superior cash flow coverage. Antero Midstream pays out approximately 91.8% of its earnings in the form of a dividend, a payout ratio that is high but manageable given the stable, non-cyclical nature of its fee-based revenue. A potential driver of stock price appreciation is yield compression. In a scenario where the market begins to value Antero at a yield of 4.5%, similar to high-quality peers like Energy Transfer, the share price would need to rise to $20 to normalize the yield. This compression is often driven by improvements in credit ratings or an overall decline in market interest rates, both of which were observed in late 2025, as Moody's upgraded the corporation's credit rating to Ba1.
Capital structure and debt management. Antero Midstream has maintained a rigorous focus on strengthening its balance sheet, a priority that has been well received by credit rating agencies and equity investors alike. The deleveraging from 2021 to 2025 has been a key factor in the corporation's ability to fund large-scale acquisitions without compromising its financial stability. Leverage trends and target ratios. As of September 30, 2025, Antero Midstream's leverage ratio stood at 2.7x net debt to trailing 12-month TTM adjusted EBITDA. This represents a significant improvement from the 3.1 to 3.5x range seen in previous years.
The corporation's long-term target is to maintain leverage at or below 3.0x, a level that provides flexibility for both organic growth and the return of capital to shareholders. The recent historical progression of the corporation's leverage profile is summarized as follows. December 31, 2024, leverage fell to below 3.0x with net debt of $3,110 million and adjusted EBITDA of $876 million. September 30, 2025, achieved a leverage ratio of 2.7x based on net debt of $3,029 million and TTM adjusted EBITDA of $931 million. The financing for the $1.1 billion HG acquisition involves a mix of bridge loans, proceeds from the Utica divestiture, and new senior notes. Despite the large net outlay of $700 million, the incremental EBITDA from the acquired assets is expected to keep the leverage ratio near the 3.0x target almost immediately upon closing.
Debt maturity and refinancing activities. Antero Midstream has been proactive in managing its maturity ladder. In December 2025, the corporation priced an upsized $600 million offering of senior unsecured notes due 2034 at a coupon of 5.75%. The proceeds from this offering, along with the $400 million from the Utica divestiture, are earmarked to fund the HG acquisition and retire near-term debt. This strategy of pushing maturities out while maintaining attractive rates has significantly reduced the corporation's financial risk. With no major debt maturities occurring before 2027, the corporation can focus its free cash flow on dividend growth and the execution of its share repurchase program. Operational efficiency and the technology factor. The underlying profitability of Antero Midstream is driven by technical innovations and a focus on capital efficiency. These soft factors often go unnoticed in high-level financial reporting, but are critical to the maintenance capital. The compressor reuse program. One of the most innovative aspects of the corporation's operations is the relocation of underutilized compressor units. Compressor stations are among the most capital-intensive parts of a midstream system, and the ability to move existing units to new pads, rather than buying new ones, has saved the corporation hundreds of millions of dollars over the last decade.
In the first quarter of 2025, the Torrey's Peak compressor station was placed in service, representing the third station to utilize relocated units. This project alone saved an estimated $30 million in capital expenditures. Management has identified a further $85 million in projected compressor reuse savings for the 2026-2030 period. This strategy not only reduces CapEx, but also speeds up the timeline for bringing new production online, as relocating existing equipment is often faster than ordering new units with long lead times. High-rate water systems. The integrated water system supported 349 continuous pumping hours during a completion operation. By providing high-rate water delivery, the midstream system allows Antero Resources to complete wells faster and at a lower cost than its peers. This efficiency is additive to the Midstream Corporation's cash flow. Because water handling fees are charged on a per-barrel basis, faster completion rates lead to higher volumes moving through the system in a shorter amount of time. The integration of the HG water assets in 2026 will further expand this capability, adding more withdrawal points and storage capacity to the northern Marcellus fairway. Pipeline utilization and JV processing. The joint venture with MPL XLP provides critical processing and fractionation capacity for AR's liquids-rich gas. As of early 2025, this capacity was 100% utilized, reflecting the high productivity of the Marcellus wells being connected to the system. This full utilization ensures that the corporation is receiving a maximum return on its invested capital in the JV, contributing approximately $135 to $145 million in annual distributions back to Antero Midstream.
Macroeconomic demand drivers, LNG and data centers. The future outlook for Antero Midstream is bolstered by two structural shifts in North American energy demand: the expansion of the LNG export market and the surge in power generation required for data centers and artificial intelligence, AI infrastructure. The LNG export bridge. The United States is on track to significantly increase its LNG export capacity by the end of 2025 and into 2026. Antero Resources is one of the largest suppliers of gas to the Gulf Coast export hubs, and any increase in export demand directly benefits the midstream system that moves that gas. Management anticipates a 4.5 BCFD increase in LNG demand exit 2025, followed by another 10 BCFD over the subsequent 2 years.
This global demand provides a floor for natural gas prices and incentivizes the continued development of the Marcellus Shale, ensuring a steady stream of throughput for Antero Midstream's gathering and compression assets for decades to come. Data centers and power generation. A more recent trend is the regional call for natural gas to power new data centers in the Appalachian region. These centers require massive amounts of 24/7 baseload power, and natural gas-fired generation is the most reliable and scalable solution for meeting this demand.
Antero Resources has identified over 1,000 gross dry gas locations that can be quickly accelerated to serve this local power demand. This represents a significant growth opportunity for Antero Midstream, as it owns the gathering and compression infrastructure required to move this gas from the wellhead to the power plants. The HG acquisition, which adds more dry gas optionality in the Marcellus footprint, is specifically designed to capitalize on this emerging trend. Basis premiums and market access. Antero Midstream also benefits from its customers' market access. Approximately 25% of AR's gross gas is sold at TGP 500L, where the basis premium to Henry Hub reached 80 cents in late 2025. Higher realized prices for the producer improve the overall economics of the drilling program, reducing the risk of a slowdown in development during periods of low natural gas prices. This flow-through benefit to the midstream provider is a critical element of the Appalachian Basin's structural advantage over other regions like the Permian or the Haynesville. Risk profile. While the investment case for Antero Midstream is strong, investors must consider the specific risks inherent in the midstream model and the corporation's specific geographic and customer concentration.
Customer concentration and alignment risk. The corporation's greatest strength, its deep integration with Antero Resources, is also its greatest risk. Antero Resources accounts for the vast majority of AM's revenue, making the midstream provider highly sensitive to AR's financial stability and production decisions. While AR is currently an investment-grade, highly efficient producer, any long-term downturn in natural gas or NGL prices that impacts AR's creditworthiness would have a direct negative impact on AM's stock valuation. This risk is mitigated by the 29% equity stake AR holds in AM, which incentivizes the parent company to maintain the midstream provider's financial health and dividend stream. Furthermore, the long-term fixed-fee contracts provide a legal safeguard for AM's revenue stream even in challenging market conditions. Regulatory and environmental oversight. The midstream sector is subject to intense regulatory oversight, particularly concerning environmental impacts and pipeline safety. Changes in state or federal regulations regarding methane emissions, water disposal, or land use could increase the corporation's operating costs or delay the completion of new infrastructure. Antero Midstream's focus on water recycling and efficient low-impact infrastructure build-out, such as the compressor reuse program, positions it well to manage these risks, but the regulatory landscape remains a significant variable in long-term modeling.
Commodity price volatility and throughput. While AM's revenue is fee-based rather than price-based, it is not entirely immune to commodity price fluctuations. If natural gas prices fall to a level where AR must curtail production to maintain its own balance sheet, throughput volumes on AM's system would decline, leading to a corresponding drop in operating cash flow. AR's proactive hedging strategy, where it has hedged roughly 90% of the newly acquired HG production for 2026 and 2027, provides a significant buffer against this risk, ensuring that development activity continues even in a weak price environment. Conclusion. Antero Midstream Corporation has evolved into a highly resilient, cash-generative entity that serves as a vital component of the Appalachian energy ecosystem. The corporation's historical operating cash flow trends reveal a consistent ability to grow EBITDA and free cash flow while simultaneously reducing leverage and returning capital to shareholders. As the corporation continues to realize the synergies from its recent acquisitions and benefits from the ongoing demand for North American natural gas, there is a potential for stock price appreciation. For investors seeking exposure to energy infrastructure, Antero Midstream represents a case for further research.